Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic, trading along options. I'm your host, Kevin Horner. Thank you for being here, everybody. Great to see some familiar names there. And right off the jump, Miss Mighty Mouse, I'm glad to see you. It was great to see you there out in Santa Clara. Yeah, I love getting to shake the hands of viewers and attendees here, everybody. You know, we only get about 23 or 24 of those live events every year. So if you have the chance, I invite you to get to one, of course. Upcoming, our next one will be out in New York City. We've definitely got one coming thereafter in Chicago or Schaumburg. But we are all over the country every couple of weeks here. And for those of you that look forward to that opportunity, we'd love to see you. Come out and visit us there. Would appreciate it. Say hey to my friend Connie Hill there in chat, everybody. She's here to lend a hand today. She'll answer questions and comments that I'm unable to get to. But I do welcome those, of course. Would love to hear from you as we talk long options. And conveniently, I just got off stage on Saturday talking long options with many of you. So we're going to go a little deeper, I suppose. We'll talk a little bit about, thinking about long options, conceiving of when to consider one, long calls versus long puts, of course. But we're going to cover some of the basics as well as we go through it, just to remind you all of what we want to be thoughtful about. Now, what's cool about utilizing long options is that you can incorporate technical analysis viewpoints in your process. You can utilize technical analysis trends to help you discern when it may be appropriate to consider speculating utilizing long options. And I'll remind you that that's essentially what long options end up being for most traders, is speculative opportunity. So we're going to talk about all of that here. Let's cover our disclosures so that we can really get down to business. So first of all, please remember that everything we cover today is entirely for your information and your education. Remember, we do not make recommendations here. So everything we cover will be considered example only, meaning as we go forward and place an example trade, it is just an example. It is not designed as a recommendation in any way. Remember that options carry a higher level of risk. They are not appropriate for all investors. In order to trade options at Schwab, you do need to be approved on each individual account in which you would like to trade those options. You can maintain a different option approval level on each individual account, though, so keep that in mind. In order to get approved, though, you'll want to be familiar with the characteristics and risks of standardized options. You can always give us a call to request that. We're available for you 24/7, of course. We'd love to hear from you. Happy to take your call, so please don't hesitate to reach out anytime. All right, and one other note. Today, we are incorporating long options, but I'm going to take the moment just to let you all know that while we're working in a paper money platform version, if you're working in paper money as well, and you are dabbling with selling options, you need to know that in paper money, you will never get an early assignment on a sold option. However, this can absolutely happen in the live market scenario. You can be assigned on a short option at any time, even if your contract is not in the money. So while that is unlikely, it is not a non-zero chance. So keep that in mind, please. All right, so we're going to discuss the concept of long options. We're going to discuss concepts incorporating time, price, and volatility, and we're going to place example trades or two here in Thinkorswim desktop application today. So let me pull up Thinkorswim. I'm just looking at the S&P 500. We've got a big red candle today. We had some optimistic open this morning following our CPI report. But you can see that new high broke 6,300, may have brought some sellers into the mix a little bit, some profit taking perhaps. I'm looking at this chart and noting the time frame above the orange 20-day moving average continues to be pretty long. We are now at day 57 consecutively above our 20-day simple moving average, which is just awesome if we're thinking about it, right? I mean, 57 consecutive trading days, that's almost 12 full weeks. And the return from those lows is better than 16%. So just a wonderful rally out of the SPX. Now, most recently, the price action might give traders a little bit of a pause, because if you'll notice, we took out on a gap move right from here. We started moving and trending utilizing a 10-day moving average instead of the 20-day. So the question now for a lot of traders is, should we be paying attention to the 10 or should we be paying attention to the 20? So I think traders are going to be probably watching both, a combination of the two. Maybe traders are going to look at them side by side and say, you know, as long as I've got the 10 or the 20, I'm going to stay with my trade. Some traders might choose to lighten up SPX positions under the 10-day in favor of holding down to the 20-day, where they're going to feel more confident if we get a bounce. Some traders would just say, I don't mind a break of the 10-day. I can ride it to the 20. And as long as the 20 maintains, I'll stay invested. And some of you would say, you know, that's all fine, Kev, but what about the 50-day? You know, the 50-day is almost at 6,000. Do you remember how not all that long ago traders were talking about the merit of moving back to 6,000 and how that could provide some resistance? Well, all that's done is once we took the lid off, we rallied 300 SPX points. It is entirely possible, though, everybody, that having moved through that level, we need a retest of that level. So yeah, it would make sense for traders to monitor these trends and let's see if we can maintain the 10 or the 20. But if we don't, hey, we got to be aware that the 50-day could come into play. And the horizontal support coincident with that level would be right around here. So that's at actually about 6,050 or so. So in fact, let me go ahead and just put a level there. We'll just snap a little note. All right, so just something to keep in mind as it relates to the SPX. Now, I'm going to go ahead and pull up a position that you all are probably a little bit familiar with. NVIDIA had a bit of positive news here, and one of the reasons for the rally extended is tied to the fact that they've been now allowed to sell their goods in China again, and it has led to a bit of a breakout today. I'm going to go ahead and apply my basic moving average details. We're going back to my standards, 20, 50, 200 day. And we see that we've got a stock that continues its upward trajectory here. It also recaptured its 20-day moving average back here on late April. This was the 24th rather than the 23rd. But it has been a skyrocket since there, obviously, right? So at this point, traders, some of you are wondering, should I be going counter trend? Some of you are wondering, should we use today's news as opportunity to speculate that there's more upside? Both of these scenarios could be appropriate. We really don't know. But what I want to talk about a little bit is incorporating some of those details from the pattern and the chart as a means of giving consideration to where traders may look to position. Interestingly, given the move to the upside here, not everybody is going to be willing camp. I mean, I think a lot of traders would suggest, you know, hey, we've got all this upside. It moved aggressively, but rather than betting or believing rather that the stock is due to pull back deeply, they may suggest that the stock is due to move sideways rather than trend lower. And in all honesty, that might mean that perhaps long options aren't well suited to this particular position right now, because you may have more upside, you might have more downside either way. And yet the trend has shown us that as we get brief tests or breakouts, we get brief support pullbacks or sideways windows of time. And this is a good example. You know, we had a sideways move right here where we didn't give back a whole lot. I mean, our low was about 129 and the highs were around 135. That's really very limited in scope. All right. And then right through here, we had gotten into this consolidation window and our lows were like 138 up to 145, another window about 5 to 6 points. And could that be a possible way that a trader would suggest they have some semblance to play long puts? It could be, but it also could be that the time frame associated with an investment like that could just eat up all of the value or the premium in that position if the stock doesn't in fact go down. So when thinking about something like this with such an inherent upward bias at the moment, I think it makes sense that a lot of traders would maybe leave this one on the sideline a little bit for a long option play, whether puts or calls, because the movement to the upside has been so distinct and impressive. It's not to suggest that the upside couldn't continue. It's just to suggest that perhaps the trader doesn't have the comfort to play a move like this at this moment. Back here, where we were in consolidation and then got that 1 day above right here, this single breakout, this would have been a day where someone willing to speculate may have felt more confident. And I know that's simple in hindsight, given what we've seen from the trade since. But I feel like traders who are waiting to make a move now from an option side of things are perhaps a little late to the party for the trend that has occurred. Okay. Doesn't mean it can't work. All right. But the reminder I want to give you all when you're trading long options is that the amount that you put on the trade, everybody, is your worst case scenario most commonly, meaning that you buy a call option speculating on more upside. Whatever you paid for it is likely to be your loss, your maximum loss, right? If you bought the put speculating on the pullback, your max loss is likely to be the amount you spent on the put. Now, I say likely because the opportunity exists for that to result in you selling stock, selling a long position of shares one side, or maybe you use the call and you buy a call, for example, and you don't close the call contract out before expiration and it's in the money. You might be the holder of shares and you could witness the stock go against you after the fact. So just be aware of that. Okay, so let us pull up a stock that is dabbling with a potential for a breakout here. I'm going to bring up Nebius, NBIS. Now, looking at this pattern, this is the pattern, at least, that if you were to want to speculate on more upside, you might have reason to consider doing so. Let's talk about what we see from a little bit of a consolidation or a little bit of market movement here over the last, say, 5 to 6 weeks or so. We have had a pretty intriguing rally. This stock has broken out way back when. Interesting, huh? How about that? Back to April 23rd, the same day the S&P, the NASDAQ 100, the semiconductor index, they all recaptured the 20-day on the same day, and Nebius did the same. So we've seen a really good rally working against the 20-day moving average, and then it broke the 20-day for about 5 sessions here, and then through positive news just yesterday, Nebius has started to move a little bit higher. That news was, I believe it was Goldman putting them on a buy list or a conviction list, and the stock has moved favorably since. Of course, the close last Friday was around 44 and change, and here you got it up almost 10 points from there. So that's a wonderful move. The question now becomes, can it push through all-time highs and give traders a way to play this stock? Well, let's talk about it from the standpoint of the potential to incorporate calls or puts, right? So let's start with calls. Actually, no, let's start with puts for fun. Let's start with puts. So we basically, if we wanted to give some consideration to the majority of the range that the stock has traded in since things got moving here, let's say just since this pullback, this brief one, the range is basically 45 to 55, right? About a 10-point level. And that could mean a couple of things. If we can get a breakout, then some traders would tell you, see here, why is this on? All right, I don't want always, I want it on hover. I got to get, so these details don't always appear for me, everybody. I want them only on my hover. That way they don't stand out. There we go. So here's where we are. We're at about 45 here. And then 55 up here. Okay. So we've got about a 10-point range. And that means that from a measured move transaction or a measured move possibility, which of course is just that, it's a possibility, it's by no means a guarantee. But the thought from a technician standpoint is, well, if the stock can break the 10-point range that we're in, well, then it can move 10 points to the upside, right? So there's a bullish viewpoint that can be very basic. Now, the same trader could also say, but you know what? A rejection at resistance, instead of being a breakout at resistance, means that we are just as likely to visit the bottom of this range as we are anything else, right? And so some traders could utilize the belief that today's high is actually a rejection at resistance and may choose to play a long put option, believing that the stock is not yet ready to break out. Okay. Now, we don't have to speak to necessarily why a trader would feel like that, but traders are going to have their own assertions every step of the way, right? And we need, as traders, to make those plans and build a thesis and then trade around or trade that thesis specifically. So if a trader were to believe that Nebius here was incapable of breaking through 55, or maybe they believe that the developing pattern on a short-term basis is such that they've got reason to think that instead of breaking out, since we got rejected last, the first 4-hour block here of the day, if they believe that we're going back to the bottom of this range, well, they can position themselves to take advantage of that with a long put option. Now, what I want to remind you all about, of course, long put option. What does a long put give the owner the opportunity to do? It allows the owner of the long put to sell stock in the underlying position, NBIS, at their strike price up to and including expiration day. But it's not only for the trader of who owns shares in NBIS, right? They could very easily be a trader who just wants to trade the option itself. So let's look at a couple of selections for us. First of all, I'll point out here on NBIS, we do have available weeklies and monthly contracts. And yes, we could default to something for this week that feels a little short term for most traders, but that doesn't mean it wouldn't work for some. So just be aware, selecting the window to choose which series you're going to work with may have some important details of note. In the case of Nebius, it did have an earnings report back here in May, and the expectation, according to the blue question mark here, is for the end of this month, but it has not as of yet been determined. So a trader will want to make note of that as a possible incorporation to their trade, right? So when we're considering these dates, you can trade the weeklies for next Friday, the 25th, and likely not incorporate the earnings detail. But if you move out to August 1, you likely are incorporating the earnings detail. And an easy way to make note of that, everybody, bring your eyes over here to the right-hand side and just look at the implied volatility details that you're seeing here and the possibility of a move in the window associated with the contract series. So 3 days remaining to expiration. The expectation for the move from this price at 53.86 on Nebius is 380 one way or the other from here, meaning maybe we get back to about 50, or maybe we're up to about 58, 57, 58. But if you go forward, look at how next week's jumps to $6, but the week after is up to 820, and the week after that is 980. So what we're seeing is that there is higher implied volatility today, but that is tied to the news of the day. And as we go forward, the expected moves are kind of in line with expectations for a report coming either during the August 1 series or potentially the August 8 series. Okay, so that's just something for consideration. Now, of course, the more time you give the opportunity for a move, the more likely we are to have a higher cost. So if we looked out to next Friday and we were going to give consideration to the bearish view that we thought Nebius had met resistance and was apt, instead of breaking out, to pull back, then the trader might want to lean in to a review of contracts incorporating some important detail, like the Greeks. So I'm going to speak utilizing Delta, and as much as anything else, we're just going to talk about really Delta. In fact, let me just do this. Let's go back to last and net change. And let me just point out, you can customize your column set here, everybody, so that you're getting only what you want from this. So last change, or the last trade, and the net change might be important. Some traders want to make sure they're seeing the bid, or the bid and the ask are automatic, excuse me. But some of you might want volume and or open interest. And then let's just incorporate Delta as well. And see, this might be a way to do this, because now I've got the detail that matters for me right here in a customized setup. And I might even go in and just say, yeah, let's save that as, instead of what it offers me, I'm just going to change this to Kevin's preferred. So this way I know that I'm getting what I'm looking for. And that way I can leave it as such. And I can see the bid and the ask. I get the open interest and the volume of the day. And I get to see the delta on the contract. Now, why is the delta important? Let me remind you all of what delta is. Some of you may not be a little familiar, but that's okay. Delta as a ratio is, or as a valuation, is one of two measures or calculations. So many traders look at the delta as the amount of movement in the option contract that you can expect for a $1 move in the underlying stock. So this delta at 56 or 0.56, 56 cents at this 53.50 strike price suggests that if Nebius were to drop by $1, that you would get a 56% increase in price of the put contract over here. And I'm pointing to the wrong, I apologize. I'm looking at the call side, everybody. Let me bring you over to the puts. We're going to look at the puts because that's what we were talking here. I'm looking at these 55 strikes, okay? 55 strike put is $3.60, and the delta on the 55 put is 52 cents. So if the stock were to drop by $1, then we would witness, in all likelihood, if it happened immediately, like today, we would see this contract jump up to about $3.90 on the bid and about $4.10 on the ask. And again, estimations only. These can't be detailed to the penny necessarily. These are just trying to get a snapshot for you. Now, that delta can also be the percentage of likelihood that that contract closes in the money on expiration Friday. It doesn't speak to whether there will be value equal to what you pay for it necessarily, just that the contract is 53% likelihood of being in the money next Friday expiration, meaning in this case, under $55 a share. That's about a 50-50% shot, right? Not all traders are going to look at that and say, that's what I'm looking for. But a convicted trader has to think two options available, or two choices, excuse me. Do I wish to pay a lower amount per contract, like 370, and thus get a lesser bump in price for a $1 move, okay, a lower probability factor, versus playing something with a higher cost, but a much greater delta, a higher probability of being in the money at expiration? Or if you're on the right side of that trade, getting more bang for your buck as the stock falls. Now, why would a trader who is a speculator want to lean into a higher delta? Some traders just are willing to spend more and therefore want the greater price appreciation, as it relates to their underlying stock. But if you were the owner of shares, some traders who own stock and are looking to protect it want that delta to be high, 80 cents on the dollar or more, maybe even a full $1 delta, essentially getting a one-for-one movement in the put option relative to the underlying stock. Again, this is going to come down to each individual trader. What is it that they're trying to accomplish with their trade? And what is it that they want to get from the put, as an example? Are they looking for protection, true protection, at a rate of dollar for dollar, or do they just want something so that they can say, all right, I picked up some dollars along the way while the stock pulled back? Okay. So that's how some traders, may choose to think about these differences, right? The idea being, should I speculate on there being some downside against the 55 level, given our technical analysis viewpoint here? They can own a $55 put and profit as it goes lower. So they'd have to believe that the stock is more likely to pull back. And further, they'd have to believe that the stock is capable of pulling back by, at least $3.50 to the downside, which would mean that between now and next Friday, the stock would have to be down in the neighborhood of 51.50 in order to be validated, right? Because that would be a break-even price on the position. It would have to be at least at 51.50 if the trader were owning the stock to expiration Friday. Now, of course, if you've been attending a show like this one, you don't need to hold your contracts, to expiration. Many traders will allow the trade to get covered early if the stock moves in their favor sufficiently. Many traders are going to look at a 40, 50, 60% move in their favor as sufficient. But as I always mention, having a thesis about what you think can happen, how do you want to handle your trade? Those are the things that matter most. Getting that thesis laid out so that you know exactly how you want to approach the trade as it moves in your favor. But the recognition further should be that if you're willing to step into a put contract at the $55 strike, for example, and you're going to spend the midpoint, $3.60, well, you got to be willing to say that $3.60 could easily become zero. Okay. Now, it is true, everyone, that you can choose to sell that contract as it loses value. So if you put on the put here and you buy it at 360, in fact, let's go ahead and follow through. We'll go ahead and do an example trade to buy the put at the midpoint, 360, in between the bid of 350 and 370. We'll do this as an example trade. Notice that our break even is basically 51.40. So if we're holding it to expiration and it's under 51.40, then we would expect to be in profit. Our max profit is associated with taking the stock to zero. So what is the likelihood that we get max profit from this trade? Pretty unlikely, but not zero, right? So best case scenario is worst case, a max loss we have is $360. on the trade. We can't lose more than that, in terms of holding the put option here. Okay, so we'll go ahead and send that off. We put ourselves in a position there. So we've got an example trade on how to go about placing a put option. Now, let's talk about the thought associated with Nebius if the trader wanted to play the other end of that. Now, in this case, trading the other end of it could just be the same series, right? We might look at the same expiration Friday, just a week from this Friday. We could go a little further, though, or we could base this exclusively on the price action of the stock. So what do I mean? Well, have you all given thought to the idea of maybe buying a call option if the stock were to break out? Okay, so some traders would say, yeah, I'd be willing to buy a call at the same strike we sold the put at, our example put contract. But we're going to, again, I want to think about it from a standpoint of a different trader altogether. Okay, so not a trader who already has a put on Nebius, but rather a trader who believes that a breakout is imminent or coming, but they don't want to step in before that breakout begins. And that's just technical analysis process, of course, right? We say often a new closing high is not bearish. And if the stock were to actually close at a new high, by the way, our high close here is 55.33. So some traders would say if we can close above 55.33, well, then I'd feel really confident that I could play the upside move, or that I'd have more willingness to play the upside move, for example. So a trader who feels that way could position a buy of an option based on the underlying stock's move. So let's look at how that might happen. Quickly, I'm going to do a little math on this. As an example of how a trader might look at a violation of an all-time high close, we had a high close at 55.30. And let's say that we're going to go 1% above that, okay? So 1% above would be 55.85, okay? And we could even go to 56 if we wanted to. But let's give some thought to how that might work. So the trader comes in to their weekly expirations, and you know what? Because the trader says, I want to buy this on a breakout only, let's suggest that they want a little more time. So we're going to go to August 1. Now, yes, we don't yet know if this is definitively going to incorporate the earnings, right? Just a possibility. So let's suggest for our example that we go out to this August 17 day, and the client, or rather the trader, wants to pick up an option, not to speculate, yes, but they want to buy something a little higher in delta. They want to expose more dollars for a higher probability move rather than fewer dollars for a lower probability move. So let's look at the 5250s right here are at $4.70. 450 by 470. And the delta is 59 cents. Now, if we get the breakout, then it's much more likely we're going to see a higher delta. That's going to be over 60 cents. Let me do a little bit of math with you all here. We have the stock at 53.82, and our expectation for purchase would be about 2 points above. Remember, I did a little bit of math. Let me put this on the dashboard for you all so you can see my, whoops, not that dashboard. I meant to say scratch pad. There we are. All right, so let me eliminate all of this. And so what I did was I took 5530 times 1.01, and that gets me my 55.85. And that is my 1% above the all-time high close. So this is allowing me a little bit of math so that I know the price I want Nebius to trade at in order to take my call option trade. So how am I going to incorporate that 55.85? I'm going to go into my order window. Okay. But before I do that, I need to know what is the likely price that I'm going to see if this contract is trading, if the stock is up 2 points from here. So the first thing I need to do is I need to add a $2 move here, everyone. So if we get that $2 move, it should be not 54.89. Last trade is 53.80. That should be $2. See there. That should actually be at 55.89. I'm not sure why it's not doing that math the same way, but let's see. Does it do it if it does 3? So it's skewed. These numbers are a little skewed somehow, everybody, but it's supposed to be. I want to make sure that my resulting price is equal to the price that I would like when I'm breaking this out. So we're going to add to 50 cents here, which should get me to above my level. Okay, it's close to it. Ultimately, what it's telling me is my theoretical price for the strike we were looking at would be about $1 higher. So let's say that I'm willing to go, I'm going to round that up to about $6 limit, okay? Now, here's how we would make sure that we are only buying this if we get the stock to break out. Oh, is it on percentage? Thank you. Good catch. Yep, you're absolutely right. That's exactly why, everybody. Thank you. Appreciate it, Chris. Thanks, man. All right, let's see here. Let's make this what I wanted it to be. How about $2.10? There we go. Now I feel better. Thank you. Okay, so the 52.50 that I'd like to buy at 470 could be at $6 if we get a close over 53.80. So I'm going to go into the order details here, and this is what we're looking for is the gear, everybody. We find the gear and we get the pop-out window. Okay, now the pop-out window is where I get the opportunity to designate my trade. So yes, I want to buy one contract with a limit order at $6 for my August 1st 52.50 call, but I only want to do this with Nebius trading at a mark of greater than or equal to 55.85. Now, you can incorporate as well a look at this. Let's say we did this at the final 5 minutes of the market. Okay, so today's date, as long as it is 3:55, or I guess we should make that in military time, that would be 15:55. So the final 5 minutes of trading, and Nebius has to be above our required value at 55.85. Okay, and if that criteria is met today, okay, and it's at least this time or later, and the price is at least 55.85 or better, then I want to place a buy limit at $6 or better for my August 1 52.50 call that expires August 1st. Okay, so does that make sense for an understanding of what we could be thinking about as it relates to our example trade? We've incorporated price action relative to the stock. We've required for the stock to make a new high for us to generate the trade we want to be in. In order for that to occur, the stock's got to be trading above that level in the final 5 minutes of trading. Now, does that guarantee that it closes at a new high? No, it doesn't. But we are admitting a little bit of risk to that extent. You can change that time frame a little bit if need be, but ultimately we're trying to get the stock to make that breakout and then allow us to place our trade based on that breakout. And the reason for the waiting on the breakout, of course, is that the odds are in our favor for a continued move to the upside, but only after a close at a new high, right? Because otherwise, we're going to consider, as a technician, is going to consider having run to that same 55 ledge and been pushed back again. They're going to consider that to be resistance, in which case that put conversation becomes the proper consideration at that point. Okay? So let's go ahead and hit our confirm and send for example purposes only. We notice that if we make this purchase, we are only going to be doing it with NBIS at or above 55.85. And in this case, we've got a new break even at 58.50. That would mean that the stock would have to trade above 58.50 on expiration Friday for us to at least break even, given our entry at $6. And our max loss would be associated with the amount of dollars we invest in the trade. $600. What would our max profit be? It's always going to show infinite, because the expectation, of course, there is no level that price cannot move to on the upside. It can continue to go. We know it can't be officially infinite, but the idea is that there is no limitation to profit. There would not be. So we'll go ahead and send off an example trade for our example portfolio. And then in the future, if that one goes, that might be something I get to address in a different conversation with you all down the road. But boy, I'm a big fan of utilizing all the tools at our fingertips here in Thinkorswim to put us on a trade that makes sense for how we want to address it. And again, if nothing else, the reminder can be, while the technical details are there, you can build your thesis. It doesn't mean it has to play out the way you think it's going to, right? And so patience in the move and a requirement for the move to actually begin before the trader takes position can be something that a trader incorporates in their process, and it can actually help us to be a little more risk defined in that process. Stay Gold, great question here about the Horner rule. I'm only bringing an answer for you here because I'm leaning into long options today. In the Horner rule scenario, a trader may very well feel more confident by leaning into that, what we just did, the closing at a new high. Remember, the Horner rule doesn't speak to how long you're needing for confirmation. It just speaks to the idea of needing confirmation. For some traders, it is going to be just one day at a new high closed. A new high close level may be sufficient for an aggressive trader. Other traders might want a second consecutive day, a third consecutive day, etc. But many of you might consider that very first day closing at a new high to be that confirmation, in which case maybe that Horner rule is already in play if that happens. So again, just remember, having a plan is a big part of it, but defining what you as a trader think of as confirmation, whether it's a percentage move through resistance, a number of consecutive close through resistance, it's all, and as Dragon Rider is pointing out, if-then methodology, right? If this happens, here's what I'm going to do. If this happens, here's what I'm going to do. You're giving yourself the playbook to your trading process. And ultimately, that should make your decision making in the moment a lot easier and a lot more consistent as well. All right, everybody, we're going to wrap it up there. We're just about at time, so I want to thank you for being here. Thanks to Connie Hill, of course, for managing the chat. I think in terms of what we've covered today, the answer to Miami Trader's question about can we use these for any process, the conversation around the technicals can absolutely be applied. The use of the theoreticals can absolutely be applied in just about any scenario, but we just didn't get to it today. So my encouragement would absolutely be to look within the channel here and search specifically for debit vertical trades, short put verticals, short call verticals, whichever you might like to see. We've very likely got a class on just that for you. So if you haven't already done so, follow Connie and me on X, Connie Hill CS, Kevin Horner CS, and a big thanks to all of you hitting that thumbs up button down below. Our friend Cameron May likes to note that sounds like applause to us as coaches. It sure does. We'd love that. So thank you so much for being here, for participating in this show, and I appreciate you all doing so. I look forward to following up with you all again real soon.